So hello everyone, today at RankiaPro Europe we have two special guests, Cristina Jarrin and Mikaël Dauvert from Irivest Investment Managers, who are both senior portfolio managers and both with a really impressive experience of over 25 years on the convertible bond market. Thank you so much. How are you?
Thank you. Pretty well, thank you. Thank you for the opportunity.
Thank you.
Thank you so much. So maybe let's start with some background. How do you think that the global issuance of convertibles evolved during those years? And how do you think, what are the regions that are driving this trend?
The global issuance of convertible bonds has recently undergone a significant evolution, moving from a period where the market size remained largely unchanged for nearly 15 years to witnessing a remarkable surge in volume. So this trend has accelerated in 2024 and 2025, and this has been driven by the strong cost advantages that convertible bonds offer issuers, especially in a high interest rate environment. And just to give you an idea, up to September this year, global issuance reached 125 billion US dollars, already exceeding the total issuance during the whole year in 2024. The most dominant global theme that is underpinning this recent issuance is the AI investment cycle. So over half of 2025 year-to-date issuance has been linked directly or indirectly to AI, involving companies in core AI infrastructure, software platforms, and adjacent sectors like crypto mining firms. And this surge in global issuance has been led predominantly by two regions: the United States, that accounts for approximately 2/3 of the global space, with prolific issuance among the small and mid-capitalization companies, and Asia ex-Japan, with issuance that is comprised a near record of 20% of global volumes. And this is frequently driven by Chinese mega cap companies that are issuing large convertibles to fund share repurchases or capital investments.
Thank you so much, Christina. Very informative. And do you think that the investors fully appreciate the role that global convertibles play in asset allocation, or do they still treat it like a niche product?
Yeah, it's a very good question, and I think that investors do not yet fully appreciate that comprehensive role that global convertibles can play in asset allocation. So, despite the strategic benefits that global convertibles offer, such as the asymmetric risk reward that is combining bond-like protection with equity upside potential, many investors still see them as niche products that's only for a specialized investor base. However, this perception, I think, is evolving. In 2025, the market environment that has been marked by volatility and uncertainty has demonstrated both that convertibles have resilience in downturns and also the ability of the asset class to capture the equity upside. And I think this behavior has helped the case. Although convertibles bond markets remains relatively small compared to total equity and corporate bond markets, its distinct characteristics, such as its lower interest rate sensitivity, the senior ranking in the capital structure, and the exposure to innovation-driven companies, position it as a complement to traditional 60/40 portfolios. So furthermore, institutional engagement and issuance volume are increasing in the asset class, supporting the view that convertibles are transitioning beyond this niche status towards a broader strategic allocation role for investors seeking to improve diversification and risk management in their portfolios.
So, how do you think do the institutional clients like pension funds or insurance, how do they typically use convertibles within their broader portfolio?
Institutional clients such as pension funds that you mentioned and insurers typically use convertible bonds within their broader portfolios as a strategic bridge between equity and credit. So the dual nature, consisting of the fixed debt plus the embedded call option on the issuer's equity, offers a combination of equity upside participation and fixed income downside protection. So institutional investors integrate them tactically across equity and fixed income portfolios. With this strategic allocation, we can have as an example three main use cases. One, convertibles as a credit plus. So that is within fixed income allocations, convertibles enhance the total return potential of the portfolio relative to straight credit-only products, while maintaining the senior claim status of a fixed income product. So the embedded optionality of convertible bonds provides the convexity that traditional bonds lack, improving the risk-adjusted return across fixed income portfolios. A second use case is convertibles as equity substitute with downside protection. So convertibles can be used as a lower volatility equity alternative. And this alternative is particularly valuable for matching constraints or regulatory capital requirements, such as of Solvency II. So convertible bonds have a favorable treatment versus pure equity, which improves the capital efficiency and the return of equity for insurers, for example. And the third use case, portfolio diversification. So convertibles offer this unique exposure that differs from broad market indexes, which enhances diversification. So convertibles provide exposure to innovative and high growth sectors, such as technology, consumer discretionary, and healthcare. They provide opportunities across the market cap spectrum beyond the mega caps, and relative to conventional bonds, they have a low correlation to interest rate fluctuations. So these three main use cases are how convertibles are used in institutional clients, such as pension or insurers.
Thank you so much. That's really interesting. And let's talk about Dynasty Global Convertibles B Euro. How does this fund differ from traditional bonds, and how does this differ from multi-asset funds?
That's a good question because it's where the value of our fund lies. The Dynasty Global Convertible Fund clearly stand out of the traditional bonds or multi-asset funds. We do this by taking advantage of the unique asymmetry of convertible bonds with an active and defensive approach, which is totally unconstrained by any benchmark. First, the hybrid nature of the convertible is key. Unlike a regular bond fund, which focus only on interest rate and credit risk, we manage four dimensions at the same time: equity, credit, rates, and the structural feature of the convertible itself. Also, unlike a multi-asset fund that simply allocates between asset class, we actively exploit the hybrid nature of instruments that give us an asymmetric risk return profile with low correlation to traditional markets. Second, our approach is all about convexity. That's really our performance driver. Convexity allows us to capture part of the equity upside with will limited loss when the markets fall. To achieve that, we control equity sensitivity very tightly, keep it within a defensive range of 20 to 40%. Finally, our management is both selective and responsible. We are fully benchmark free with a focused portfolio of about 50 to 70 positions. We invest in companies with solid fundamentals and strong growth. We are also classified as an Article 8 fund under SFDR, and we fully hedge currency risk. So in short, we offer a hybrid, active and defensive strategy, a differentiated and resilient alternative in today's markets.
Thank you so much, Mikael. And the last question regarding that. So, are there any key indicators that you think investors should have in mind when it comes to this fund?
Absolutely. Very really at the heart of our analysis. There are a few key indicators we look like to assess the quality and the behavior of our global convertible funds like us. And the central one is make sure the fund maintains its asymmetry profile, meaning it captures equity upside while limiting downside. We focus on our side on three main areas. First, equity exposure management. The key indicator here is the equity sensitivity. We actively manage it with a defensive range of 20 to 40%. That's really the barometers of our market exposure, and it reflects our approach which is active, dynamics, and clearly defensive. Second, security selection and risk control. We invest only in solid companies with a strong fundamental and low leverage. We exclude high-risk names, especially with very wide credit spread. We closely monitor both the fund duration and the issuer quality, because that's what provides the bond floor, the real protection when the markets are under stress. Third, portfolio structure and liquidity. The portfolio stays focused with usually between 50 and 70 positions, with a maximum exposure of about 5% per line. We prefer liquid issue and maintain around 5% in cash to stay flexible and capture opportunity. And of course, we track performance and risk metrics. We aim for solid return, target volatility of around 6%, and a strong Sharpe ratio. But for us, one of the key metrics is the drawdown, its depth, its durations, and the recovery time, because that's a true test of a defensive strategy.
Thank you so much, both you, Cristina, and you, Mikaël. And now I have two questions that maybe are not related to the topic, but also super important. So I wanted to ask you, how are you going to spend this Christmas holidays?
On my side, with my family, in Europe's official Christmas capital, that is Strasbourg. I'm looking forward for a winter break, sipping mulled wine, vin chaud in French, and having some traditional Christmas cookies, bret de l'eau.
And in myself, I will take this short holiday break to recharge my batteries. It will be a traditional Christmas in Paris with my family and my 3 young boys. These moments are really precious to unwind and reconnect. And I will be back at the office right after the holidays, full of energy, ready to tackle our 2026 objective.
Wow, that's really beautiful. And what will you ask Santa Claus this year?
I think I will take the risk and sound like a Miss Universe answer. So for me, it's world peace. But I sincerely mean it. And as someone who watches global markets daily, sustainable peace isn't just morally right, but it is essential for inclusive human progress.
Well, in my side, already have a choice of a family with 3 young boys. So I will probably ask Santa for a bit of more organizational serenity at home. But business-wise, our hopes it will be just as generous in 2026 as it was in 2025, at least when it comes from performance for us, our asset class. That will be the best reward for the investor who trust us, and surely a great way to attract the new one as well. And for the rest of the wish list, my boys are taking care of it with plenty of ideas.
Thank you so much. That sounds really beautiful, and let's hope it will happen. Thank you so much, both you, Cristina and Mikaël, and thank you to everyone who was listening to our podcast. Stay tuned. Don't forget to share the interview on social media, and don't forget to subscribe RankiaPro Europe. Thank you so much.
Thank you.
Thank you very much.